Or I wonder if that fixed it. YouTube may have sound now. If anyone can check, I'd appreciate it. Cool. Look at that. The tech team at T3 better watch out. I'm gonna be the next tech guy here at T3 soon. I'll be taking over. I don't even need those guys anymore. All right. Let's talk a little bit about today's trading session. Pretty strong day. It looks like we upticked further after hours. So including a little after hours uptick, we're up about 0.9% or so in the SPYs. Qs here up about 0.9% as well. The IWM relatively weak, up 0.14%. Going over to the charts. So it's an inside day today for the SPY. It's not an inside day for the Qs by like 2 pennies, and it's not an inside day for the IWM by a good bit. The IWM had a lot of relative weakness today. It actually broke down pretty hard early on in the day before getting a little bit of a snapback. But the S&P here had an inside day. I would describe that as a bullish inside day. We closed on highs. Friday was a pretty bad candle. The third pretty bad candle that we've had here as this market has produced a little bit of a price correction. And kind of what I said in the morning meeting was, on the one hand, I feel like I got the major part of the pullback that I was looking for, but I'm also going to recognize that it's not completely impossible for us to have an even deeper pullback, pulling back, as deep as 435, I think is possible. So I want to just continue to follow the short-term trend, and I want to continue to keep those short positions on and manage them until the market proves to me that the bulls have regained some semblance of control. The way that the bulls would prove to me that they've regained some semblance of control at this point would be by negating Friday's candle, so getting above Friday. And today with an inside day, there's no sound of the VTF. Before everyone was just hearing me. Okay. Someone tell Oriel to log off and on. In order to get the market to become more bullish, we need to clear Friday's high, is what I'm trying to say here. And one of the ways in which you can negate a really bearish candle like Friday's candle is actually through an inside day. So this is really productive. If you're trying to be bullish on the market, I think that today was like the best you could possibly have hoped for. You got a really strong inside day. We retraced more than 50% of yesterday's candle. We closed pretty much on highs. We're even ticking up here slightly after hours. And if we can get an inside and up tomorrow, it potentially sets us up to negate Friday's high. If we negate Friday's high, then it looks like the bulls have really kind of maintained and kept control. And if you've been trying to push to the short side a little bit like I have been, it would mean you need to take your foot off the gas pedal and possibly flip long. My game plan kind of always when I've been getting short in this bull run has been to start buying back some of the longs that I sell on the way up, buy them back on the way down as I cover my shorts slowly on the way down as well. So that's pretty much what I did on Friday. Not that I've gotten huge to the long side. I haven't. I've got some names that have really been on my radar where I'm looking for these deeper price corrections, and I almost got a few of them today, and I just didn't quite get to the prices that I wanted. With that said, some of those growth names were like a day 4 to the downside RDR today, and I just wasn't being aggressive. But that's fine. My game plan was to not be aggressive. I'm really trying to be patient. I'm trying to let the market come to me. I'm trying to let these bigger dips come to me that could put me in a much better risk-reward situation on those longs. And if I don't get filled on all of them, that's going to be just fine. It's like some of the ones I was looking at were Unity today. But I wanted a deeper pull in this Unity. The low is 38.80. I wanted at least 38 bucks on this thing, if not a little bit lower, 37.50, in order to start building in. And I was off by $1 or so in Unity. $1 in this name is really nothing compared to how it moves. But it was a day 4 to the downside. It closed a little bit of a tail there. Again, I'm just trying to be patient, even though I recognize that it's extended. Shopify was another one. I said in the morning meeting, like $55 to $56, I think is where I would want to potentially start looking to build back into a little bit of a long position. It was a day 4 to the downside. It actually stayed pretty weak. It closed red, but never got quite deep enough for me to enter the position. Pinterest was another one. I was looking at 26.50. I had a bid at 26.51 this morning. Low of the day is 26.57. I didn't quite get it. And again, all of that is fine. So I'm looking for these bigger dips in some of these names to potentially begin to build in. Apple, I've done that now. I'm very small at this point, starting to build into Apple. And that's on the dip side. On the short selling side, we had a nice little gap up this morning that I actually think created some good short-term shorting opportunities on that gap, which is exactly what we were looking for in the meeting today. A common gap up in a market that's gotten bearish is something that we generally want to short. If you look at the SPY, it was not the best thing to probably go after because the Dow was so strong. But some of those growth names, tech names, IWM related names, if you shorted the gap up in them, a lot of them worked really well. Like this XBI was just incredibly weak. I mean, even if you were just shorting the Qs themselves off the open or things that were related to it, looking for this pullback early in the day. That was my broad opening game plan. I did that, and then I basically did nothing for the rest of the day, to be honest. There was just nothing going on. I mean, this market was incredibly boring. We talked about all morning QQQ 374. It's so important if the market can get back above 374, and we just couldn't really do that all day. We kept holding as resistance. We finally broke above, and it turned into a little bit of an upside grind. For the SPYs, we had wanted to pay attention to 449 when it broke back below it. We recaptured that one actually much quicker at 10:05. Had a little bit of an upside grind the rest of the day, but for the most part, today was an extremely boring trading session. There wasn't really much to push for. I don't think shorting the common gap up was a decent trade if you had good name selection. I blew some money in this Genius Sports, GENI. Thought that the earnings report looked pretty good. I thought the daily chart looked pretty good. No short float to speak of. Gapping up above $8. Just total failure there. A little similar but different to Fubo on Friday that gapped up above resistance on a good-looking earnings report. The difference with the Fubo is that this one actually has a pretty high short float, but they wrecked that back down. You can look at Upstart today. Upstart got absolutely destroyed. Carvana had a weaker day as well, so they continued to finally take some money out of some of these short squeeze names that have just gone up so much in such a short period of time. It's not surprising at all to see Carvana back at almost $50, and if anything, I hope somebody caught this short on Friday because we had mentioned this as a potential short setup with this inside day. If it breaks this trend, that you could get a very fast pullback to $50. It's exactly what we discussed. It's exactly what you got in 2 trading sessions. It's just been a really big run for some of these names, and it seems like the market is adjusting a little bit and that there's some money coming out of them. Even AI, which is a decent little downside tail, a lot of weakness and kind of breaking some support. So some money coming out of those names, but overall the market's holding in really well. I mean, the Dow, which I don't look at that often, was extremely strong. The Dow almost fully negated Friday's trading session today, which is really impressive. It helped the SPY have a lot of the strength that it was able to have. Big cap tech was very mixed, depending on which name you're looking at. You had Apple just incredibly weak all trading session. It felt like it could not catch a bounce. I think we even called out a short here on the retest of this 180 off this pivot that worked out really well if anybody took it. Tesla also spent at least the first half of the day extremely weak before having a V-bottom. But then you had others like Google. Google was incredibly strong, incredibly early, and it just makes sense. It seems like we're having some winners and losers in big cap tech based on those earnings reports. Google with a great earnings report traded really well today. Meta, off that great earnings report, traded really well today, even though it's an inside day. This Meta daily chart's looking fantastic. I say that even as I am still short a little bit of stock in it. Amazon, back above 140, looking fantastic, though still extended for the earnings report. So it definitely seems like we've got some haves and have-nots in mega cap tech. Financials were super strong. I liquidated my Bank of America position into the close. I'll look to revisit that on a dip. And overall, I think it was a good but boring trading session. I think that we were pretty on point just with how to handle the gap up early on, pretty on point with recognizing where the relative strength and relative weakness was on the market. And even though I adopted a pretty defensive approach to my trading today, there was money to be made. So, good stuff. I think that's all I've got. So I'm happy to answer any questions that you guys have. Is Palantir back up? You know, this Palantir, they sold that thing all the way down. The report came in. The report looked fantastic. And I was a little bit slow. I bid in like $16.50 to try to get some stock on the way up. I got nothing. And now it's all the way up here at $18.30. I was definitely a little bit slow on pulling that trigger. But the Palantir report looked excellent across the board from what I saw. Meanwhile, the opposite, this Lucid, this report I thought looked awful, and initially has upticked higher. I guess no one cares how much money this company loses as long as they're able to produce 10,000 cars next year. How is this even a company? I say that as I'm long. I kind of don't want to be long this stock anymore. It's really bad looking numbers to me. Any questions, guys? Happy to answer any questions anybody has. I'm pretty beat today from the Metallica show last night. Not sure if anybody went to it at MetLife Stadium. It was awesome. It's 2 weeks in a row where I'm tired on Monday. Not great. Tough way to start the week. I didn't see the Paramount numbers. Welcome, Ashani. Welcome, welcome. Hope to see a lot of you in here. Scrolling up for the Paramount numbers. I don't see them. What's Beyond Meat doing? Beyond Meat's getting smoked on its report. Revenue's a miss. EBITDA loss. Worse than expected. International net revenue was a bit of a beat. And they guided down, it looks like, on fiscal year net revenue. Guide down on Beyond. That's probably what's really hitting it more than anything. Can't guide down. Yeah, Palantir numbers look great. What's Chegg doing here after hours? Chegg actually up. Look at that. This thing has just gotten wrecked. One earnings report after the next. Like one after the next. This is so many massive gap downs in this thing, going back to 2021. With this initial gap down from like $60 down to like $35. I remember that one very vividly. Followed by another really bad earnings report here in May, one decent report, and then two other really big gap downs. That Chegg's been gross. Oh, there's the Paramount numbers. What's Paramount doing here after hours? Up about 7%. Let's see in estimates. Yeah, Chegg got smoked again on that last report because they said that they basically in the last earnings report said that they don't know if they'll be able to continue to exist because of artificial intelligence just taking over their business, and the market hated it. It was like the only company that I can recall from last earnings season that actually took a hit really bad on AI. From Cameron, how much will you risk on your add backs compared to what you risk on the original position? By definition, with an add back the way that I do it, you shouldn't be taking on any additional risk. There's no additional risk. You're just taking back risk that you already had on. So, you know, let's just try to use some simple numbers. Let's say that you bought 1,000 shares of stock for 10 cents worth of risk. So you're risking $100 on the trade. You sell 500 shares, 10 cents in the money to get your risk covered. Now you've got 500 more shares, right? So your risk is fully covered. You've got 500 shares left, and if the stock goes all the way down after you've got your one-to-one kick, then your worst case scenario is a zero, right? Let's put some numbers around it. You bought at $50, 1,000 shares, sell stop at $49.90, $100 worth of risk. You sell 500 shares at $50.10. Now your sell stop at $49.90 becomes 500 shares. You put $50 in your pocket. If it goes down, rolls you over, you lose $50 on the other 500 shares, you'd end up with a zero. But instead, the thing continues to move higher. And then when you're 50 cents in the money, you sell 100 shares with the idea being that you'll buy it back on a 25-cent pullback. So you sell 100 shares at 50.50, and then you put a bid back in at 50.25 for that 100 shares. If it comes down, and let me actually take a half step back. Let me present two scenarios for you. Stock fills you at 50.10, right? 500 shares. So now, same thing. Your sell stop is that 49.90. So your worst case scenario is that you're at 0. Scenario number 1, stock goes all the way up to 50.50. You don't sell anything, you don't do anything, and then it comes all the way down and stops you out at 49.90. You made 0 on the trade, right? At one point you were up a lot. You were up, 500 shares at 50 cents, so you're up $250 on that 500 shares in open P&L, plus the 50 that you booked for yourself. At one point you were up $300 in the trade, but you didn't actually sell anything after the 1-to-1, so it comes all the way down, and scenario number 1 is that you are a donut, right? And just stop me anywhere if what I'm saying you're not following along with, or I'm not making any sense. Scenario number 2, you do the exact same thing. You sell 500 shares at $50.10. When it gets up to 50.50, you sell another 100 shares, and the plan is to add it back to 50.25. Okay, so it goes up to 50.50, and now the trade does the same thing as scenario 1, right? So you sell another 100 shares at 50.50, and it goes all the way down to 49.90 and stops you out of that 500 shares. Why 500 shares? Because you rebuy 100 shares on the way down to 50.25. How much money do you make or lose in that trade? You make $25. But how much additional risk did you put on in the trade with the add back? 0. 0, right? Because if you never sold any there, your worst case scenario is $0. If you sell the 100 shares, but you plan to just rebuy that 100 shares, you're going back to that 500 shares. You're not adding on any additional risk, and if anything, you'll be able to keep that difference. So you'll be able to put $25 in your pocket should that trade fully fail. By definition, if I am adding back, this is the definition between an add back and an add on a position. An add back never adds risk. I'm taking the risk back. Right? If I wanted to, I could have sold that 100 shares at 50.50 and never tried to rebuy it on the way down, right? And then, the trade goes all the way down and stops me out, and I make an extra $60 on the trade compared to making an extra $25 on the trade. But that's not the idea, right? The idea is that maybe this thing gets stuck in a range between 50.50 and 50.25, and you can sell it, rebuy it, sell it, rebuy it, sell it, rebuy it. Maybe do that a whole bunch of times. But you're never adding on risk. So I hope that makes sense, Cameron. The ads will have the same stop as the original stop unless you're doing some sort of trailing. You can trail on the way up and use a new stop loss based on those trailing rules. But otherwise, generally, you would have the same stop. Sometimes what I do, and we've talked about this in an afternoon meeting, but I don't want to overcomplicate things, is I'll take the profit that I've made from selling and adding back and actually reduce my stop, give it more room, and keep my worst case scenario at 0, right? So I could lower my stop by, what would it be, 5 cents, I guess, because of that kick. So instead of now having my stop at 49.90, I could have my stop at 49.85, and it would still be that same 0 if I wanted to do it that way. Then you're kind of trading your P&L a little bit, so you got to be careful with that, but I do it sometimes. From Ben, when Tesla broke through 250, oh, I forgot about that trade. That was a pretty good trade, the Tesla short off the open. When Tesla broke through 250 off the open, there was about $3.60 worth of space risk on the first break. Okay. I see $2.76 versus the ignition bar high. $3.65 if you're giving to the high of the day. But I think that you could use this kind of ignition bar candle, the second bar high, as your stop loss, and that's actually appropriate. But looks like your assumption is using the first bar, so $3.60 worth of space risk, which is a lot for this name. It can move, but it's a lot for this name. Was there another stop to use? That's what I just mentioned. Or was that the only one to use so early in the day? My go-to stop would not have been the high of the day. My go-to stop would be the ignition bar high, the textbook technical breakdown trade. And what do I think about the risk-reward probability profile? I like it. The risk is a little bit much for the reward, but the stock can move. You know, you really could get $10 of downside on this name in a day. So, you know, risking $2 and what did I just say? $2.77. It's still a lot. It's still a lot. So I don't love the risk reward, but I like the trade. I like the layers of probability. The market was telling us potentially down, right? Because we had a common gap up in a market that's weakened out. The stock was relatively weak, had bad news on top of it, was trading with really high relative volume. I think there was a lot of things to like about the Tesla trade from a probability perspective. And if there's any downer on the trade, it's just how much you had to risk in order to properly trade it. So, thanks for the question, Ben. From Rose on DraftKings. Just seeing Ben's follow-up. Took the part specifically asking about using the high of the candle out of the question, left in a big cool. I think it's harder for you to recognize red ignition candles. Yeah, maybe you're just used to a market that goes up. I get it though. Ashani, I'm happy to go over I'm happy to go over ignition bars and really everything with you. You have access to my training program class. I know you have access to it because I added it onto your account this morning. My training program classes go over kind of my entire philosophy on everything. So I have like the first class that I do in there is an hour-plus class that really discusses the basics of support, resistance, breakouts, breakdowns, ignition candles. I am always really happy to answer anyone's questions in any afternoon meeting, regardless of how basic or advanced that question is. But for your question in particular, I'm just going to say watch the class first, maybe watch it tonight, and then circle back with me and the team here in tomorrow's afternoon meeting if you have any specific follow-up questions on it after you go through it. I just again, happy to go over any questions at any levels, and I don't want to discourage anyone, especially a new team member, from asking any questions ever. But for the sake of time efficiency, I'm going to say just check out the class first, and then maybe in tomorrow's afternoon meeting, if you've got any follow-up questions, then happy to help and happy to review. From Rose on DraftKings. I took a trade DraftKings, the inside 5 and up at 10.05. Alright, I see it there. It's below that important 32.50. You got your risk covered, okay, great. And then you moved your stop loss up to 30.98. Right here, I hope. Seeing 31 is a low there. Because that looked like a higher low to me. Okay, so I probably would have used 30.99 because 31 itself is the low. And I agree with you. It is a higher low. It is a pivot point. It's a wedge that breaks up. You could absolutely raise your stop to there. If I kept my stop loss at the bottom of the inside bar, I wouldn't have gotten stopped out. Do you think it was a higher low, or did I force it? No, I like your stop raise here. This is just a deep pullback. I'll be honest, I don't love the initial trade. Would be the only piece of negative feedback I would give to you on it. So we had DraftKings on our radar because 32 to 32.50 is really important for the stock, and we had it on our radar because it got, I think, one upgrade from an analyst and like 3 or 4 price target increases from several other analysts, and that's off of an excellent earnings report that it had on Friday. So I had it on my radar. But for me, the way they sold this, and maybe the market played a part in that because the market was weak early on and it was a gap up, I don't think that if this stock was going to show any like real momentum and was going to have a really strong upside day, that they ever should have sold it as hard as they did in the beginning of the day. I don't like the location of your inside 5. The inside 5 is right into this equilibrium area, but below 32 and 32.50. And kind of right in a range zone. So I don't like the trade itself that much, but considering that you were in the trade, I think you traded it properly. I think that you raised the stop to an appropriate spot, you got your risk covered, everything else. But as far as what I think about it in general, I don't love the trade very much. From Dave S. Regarding your add back response, interesting. It's like you're taking a risk-free short inside your larger long position for either cash flow or for further price improvement on the position or something. Yeah, I never thought about it as like a short, and I probably still wouldn't. I get what you're saying as far as like kind of selling the stock there and being able to buy it back on the downside to keep the difference. That's like literally the definition of what a short sale is. You know, when you're selling, when you're piecing out of a position on the way up like that with the idea to rebuy it, there's a risk reward to that, right? The risk is that the stock never pulls back. The risk is that, going back to my example from earlier, I sell at 100 shares at 50.50 thinking I can rebuy it at 50.25 because had a really big move and was extended, and the thing just keeps going and going and going. Next thing I know, it's at 51.50, and I could have had that extra 100 shares of stock and been another $1 in the money, and instead I sold it because I thought that I could rebuy it. The other side of the scenario is it got really extended into that 50.50, and selling it there I could rebuy it and keep the difference. Or a third scenario, and that's assuming that the trade continues to work, right? A third scenario is that the stock goes sideways for the entire rest of the day, and I'm able to do that a whole bunch of times. A fourth scenario is that the trade totally fails, and instead of my trade giving me 0 P&L, it gives me, in that case, $25. So based on those four scenarios, the idea of selling a fifth of my position there, or a fifth of my remaining position, a tenth of my original position, is beneficial for me in 3 out of the 4 scenarios, basically. The one it's not beneficial in is if the stock just goes, straight up. But that's kind of the risk reward of doing it, and that's why I don't like doing it if I don't have a lot of stock. If you got 500 shares left, fine. And if you lose 100 shares or 200 shares on the way up as it continues higher because you were trying to, sell some stock and rebuy it and keep the difference, fine. Even better if you've got 5,000 shares and you sell 100 shares or 200 shares and look to rebuy it. That $25 still adds up. But the more you have, the less it hurts, I think, on that scenario 1, or if the trade just continues and continues and continues. It's really just kind of a math problem. What else, guys? Anything else? Let's see if there's anything in the YouTube. Cool, yeah, thanks for everyone letting me know in the YouTube chat here that there was no sound. I'm on Josh's computer at the office because my computer blew up for whatever reason. It looks like the video of me keeps freezing. From Robert in YouTube, I'm assuming you guys can still hear me on YouTube. I hope you can. I'm just seeing my face is frozen. Josh's computer is atrocious. I don't know how he trades on this thing. What was your thought process on that Fitch rating downgrade as we saw multiple people stepping up saying it doesn't matter that much? I actually agree with... Cool. I actually agree with it that it doesn't matter that much, but I still thought that the market was going to go down. Because I thought that the market already wanted to go down, and it was just an excuse for some selling to actually come into the market. I thought that the technicals had already changed a little bit. The market dynamics that we've discussed, the technicals, I thought everything was already calling for a deeper pullback, and that Fitch rating was just the excuse to actually do it more than it actually is necessarily dramatic for the market. Though obviously it is having an effect on the bond market. We see that happening, which therefore has an effect on the equity market. Also, does following day's price action surprise you? Or no, it's mostly what I would expect. Mostly what I expect in a market that's going to be a little bit weaker. Friday morning bounce, roll over into the close. The only thing that surprised me so far, actually, is the strength of today. Which, again, we are still in a bull market, so we are still in an uptrend. And if the market wants to get back above, close above Friday's high, it becomes very hard to be bearish. But overall, I think that the market is trading the way that it should. It's trading normally. From Kevin G. Do you think Thursday's range is still the key range? You're talking about Thursday the 27th that we had discussed? Is my screen share frozen also? Oh, looks like that's sort of working. So I don't think that Thursday is extremely important anymore because we broke that level. Now what I'm really looking at is actually yesterday's numbers and Wednesday's levels, basically. So like, can we recapture Friday's high? Can we recapture Wednesday of last week's high? And if that starts to happen, it becomes very bearish, very difficult to stay bearish on this market. I'm talking about the cues. Yeah, for me again, Friday and Wednesday last week are really what I'm paying attention to now. Yeah, DraftKings, it's interesting that this thing is struggling to go up on such a great earnings report. It could just be, you know, all these names have had massive runs, and, you know, we're seeing some selling coming into these, and this is one of the best ones of these types of growth stocks that are actually out there. So, keep an eye on it. From Eddie Vick in the VTF, any opinion on UPS? I don't know when they report earnings. So if you're asking me about an earnings opinion, I definitely don't have one on this. And otherwise, I think the chart's very sloppy and the stock's difficult to trade. So I don't personally have too much of an interest in it. Thanks, Sebastian. Alright, gang. I'll wrap it up. Have a great rest of your evening. I'll see you all tomorrow. If you're in the YouTube, you know what to do. Press the thumbs up. See ya.